Before Silicon Valley disrupted the world, before hedge funds hijacked the markets, there was one man who quietly rewrote the rules of money itself. In the 1970s, Wall Street had a clear hierarchy. The powerful got richer, and everyone else stayed locked out. But in a small corner office at Drexel, an analyst with a stack of computer printouts uncovered something the entire financial system had overlooked for decades. And that discovery became the spark for a financial weapon unlike anything the world had ever seen. A weapon that could build empires overnight, or blow them apart just as fast. A weapon that turned unknown businessmen into corporate warlords, and billion-dollar companies into targets. And the man behind it didn't look like a king, yet he became the most feared name in American finance. But here's the part nobody expected. The weapon didn't die when its creator fell. It survived. It evolved. And today, it's still reshaping the economy you live in. So the real question is this: what kind of invention is so powerful it outlives the king who created it? Well, here's the story. The world before the weapon. In the early 1970s, Wall Street was a gated city, and the gates were guarded by 3 letters: AAA. If your company carried anything less than an investment-grade rating, you weren't just risky, you were untouchable. Banks ignored you. Pension funds avoided you. Investment houses laughed you out of the lobby. Back then, the credit rating agencies were treated like financial royalty. Moody's, S&P, and Fitch determined who deserved capital and who didn't, and their word was final. A downgrade could suffocate a company overnight. A speculative grade label, what would later be called junk, was basically a financial death sentence. Not even established firms could escape the stigma. The system wasn't built on data, but on tradition. Established giants like IBM, Ford, and AT&T could raise billions in cheap debt because they were blue chip. Newer firms, regional companies, innovators, or businesses recovering from downturns had almost no path to funding. This wasn't a market. It was a hierarchy. And without access to debt, everything slowed down. Expansion, hiring, research, competition. Entire sectors of the American economy operated at half speed because capital could only travel through the same old channels. To make things worse, the US economy was hitting turbulence. Inflation was rising, growth was slowing, and interest rates were climbing. Companies outside the top tier were struggling to survive, and credit was tightening everywhere. Wall Street's answer? Protect the big players and let everyone else sink. It created a strange paradox. Thousands of companies needed funding. Millions of investors wanted higher returns, yet no financial mechanism existed to connect the two. The market was missing an entire dimension. That gap, the blind spot everyone else ignored, was exactly where one quiet analyst named Michael Milken would step in. Because while Wall Street saw junk, Milken saw something radically different, an opportunity nobody else understood. And once he moved, the entire financial world would never look the same. The making of a king. Now Michael Milken lived in data. He spent nights poring over default histories going back decades. The numbers revealed a truth the industry had completely mispriced. Risky companies often failed less than their interest premiums implied, meaning investors were being overpaid for fear. Wall Street's junk label was tradition disguised as wisdom. Armed with that insight, Milken joined Drexel in 1969. He was tucked into a side office handling low-grade debt. Work no one else wanted. Perfect. Because now he had a sandbox where he could test his theory without interference. Milken wasn't loud, charismatic, or theatrical. His power came from discipline. He woke up before dawn, consumed data like fuel, and built models predicting which risky companies were actually safe bets. He believed access to capital shouldn't be a privilege reserved for corporate royalty. In his mind, every great company, even Ford or Disney, was born speculative. The more he studied, the more he became convinced Wall Street was asleep at the wheel. The financial system was missing a new market waiting to be built from scratch. And Milken wasn't just the person who noticed the gap. He was the one preparing to fill it, with the most powerful financial invention of his era. So he began by creating a continuous trading market for high-yield bonds, something that barely existed. He tracked issuers, defaults, recoveries, sector patterns, and investor behavior with a level of detail Wall Street had never applied to junk. Then he did something even bolder. He convinced investors that these were mispriced assets with mathematically predictable returns. To prove it, he structured deals backed by real operating companies, not fantasy startups. Firms that couldn't get a loan from a single bank suddenly found a path to raise millions. Retail chains, cable companies, oil drillers, manufacturers, businesses locked out of the financial system now had a lifeline. And once that door opened, demand exploded. As investors chased the higher yields Milken championed, Drexel became the center of a new ecosystem. Companies approached them not just for funding, but for transformation. High-yield debt could finance expansion, acquisitions, turnarounds, even entire restructurings that traditional banks would never touch. Milken was now building an alternative capital market, parallel to the traditional one, powered by data, liquidity, and confidence. The old guard on Wall Street laughed at it, until they realized the money was real, the returns were real, and the companies funded through junk were surviving, even thriving. The weapon had been forged. It wasn't dangerous yet, not until someone realized it could do more than save companies. It could be used to take them over. Corporate warfare begins. You see, once Milken proved that high-yield debt worked, the market attracted a new kind of customer, the corporate raider. These weren't bankers or CEOs. They were outsiders, investors who believed that America's biggest companies had grown lazy, bloated, and vulnerable. And Milken's invention gave them the ammunition they had always lacked. Here's how it worked. If a raider wanted to take over a large company, they needed billions. Traditional banks wouldn't lend money for hostile takeovers. Reputational risk alone made that impossible. But junk bonds didn't care about etiquette. They only cared about yield. Milken realized that if investors were hungry for higher returns, they would happily buy bonds designed to fund raids on giant corporations. Suddenly, takeover dreams that once sounded impossible became completely feasible. Throughout the 1980s, figures like T. Boone Pickens, Carl Icahn, Nelson Peltz, and James Goldsmith began using Milken-backed financing to challenge some of the most established companies in America. Food companies, oil giants, airlines, retailers, no one felt safe. A well-timed junk bond package could allow a raider to grab a controlling stake, replace management, or force a buyout. For the first time, the financial underdogs could attack the corporate aristocracy. Boards panicked. CEOs who had spent decades in corner offices suddenly found themselves in emergency meetings, scrambling to defend against takeover bids backed by money they couldn't stop and investors they couldn't predict. And because these deals relied on enormous leverage, the stakes were brutal. If a takeover succeeded, fortunes were made overnight. If it failed, companies collapsed under debt loads they never asked for. Shareholders watched in disbelief as obscure financiers reshaped American industry. All this time, Milken was in the background, supplying the fuel. Junk bonds were powering a new era of corporate combat, fast, aggressive, and utterly unprecedented. This was no longer finance. This was warfare. And Drexel had become the arsenal. The predator's ball. By the mid-1980s, Drexel Burnham Lambert was the command center of America's financial revolution. And at the heart of it all stood Michael Milken, the quiet analyst from California who had become the most powerful deal-maker on Wall Street. His high-yield machine was printing profits at a rate the industry had never seen. In 1986 alone, Milken reportedly earned over $500 million, more than the CEOs of Fortune 500 companies combined. But the truest symbol of his power was a 3-day gathering held each spring at the Beverly Hilton, the Predator's Ball. It wasn't an official conference for bankers. It was a summit for the corporate raiders, takeover artists, CEOs, and deal junkies who depended on Milken's financing to reshape the American economy. Invitations were coveted. Attendance meant you were part of the inner circle, the elite few who could move billions with a phone call. Inside those packed conference halls, oil tycoons sat beside retailers, cable TV pioneers, casino owners, and hedge fund rebels. CEOs who once shunned junk bonds now lined up to pitch Milken directly, hoping he would finance their takeover defense or fund their next big expansion. Everyone understood the hierarchy. Drexel was the hub, Milken was the king, and junk bonds were the currency of influence. The ball was strategic. Deals were negotiated in hallways, alliances formed over dinner, and entire industries discussed as if they were chessboards. For many companies, attending the event determined whether they'd be predators or prey in the coming year. Reporters who gained access described the atmosphere as tense, almost ceremonial, a place where billions changed direction before breakfast. Critics said it encouraged reckless leverage and inflated egos. Supporters argued it democratized corporate power. To Milken, it proved something deeper. His invention had become bigger than Drexel, bigger than Wall Street. It had become a system. And when a system grows this influential, it doesn't stay invisible for long. Because while Drexel's empire reached its peak at the Predator's ball, so did the number of people waiting for it to fall. By the mid-1980s, the whispers had started. Was Drexel changing the market or destabilizing it? The warning signs were subtle at first. Companies taken over with massive junk bond financing were now drowning under their new debt loads. Some succeeded, but others buckled under interest payments they could barely service. When a raider succeeded, shareholders cheered. When a raid failed, the company and its employees paid the price. Wall Street loved the drama, but the government saw something else: systemic risk. Internally, Drexel was shifting too. The firm became famous for its highly confident letters, bold promises that Drexel would raise billions in financing for deals that didn't yet exist. Competitors hated them because they signaled one thing: Milken could summon money on command. And in the world of leverage, that was immense power. But power invites scrutiny. The SEC and federal prosecutors began digging into Drexel's activities, not because junk bonds were illegal, but because the surrounding ecosystem, the traders, the raiders, the information networks, looked increasingly chaotic. Deals moved fast, rumors moved faster, and investigators wanted to know whether lines were being crossed in the rush for profits. Drexel denied everything, but the atmosphere had changed. What once felt like innovation now felt combustible. Journalists wrote articles questioning the sustainability of the high-yield boom. Politicians accused Milken of creating a financial bubble. Rivals lobbied regulators to crack down. And behind the scenes, investigators were gathering names, documents, tapes, and testimonies. The same system Milken built, the one that lifted hundreds of companies, was now under a microscope. The fall of the king. By 1987, the pressure around Drexel and Michael Milken had reached a breaking point. Regulators were convinced that somewhere inside the high-yield empire, rules were being stretched or broken. The spark came from an unexpected source: Ivan Boesky, the legendary arbitrageur who had been a frequent participant in takeover battles financed by Drexel. Boesky was caught in an insider trading investigation, and in exchange for leniency, he turned over information to federal prosecutors. His cooperation pointed directly toward Drexel's operations and relationships within the takeover ecosystem. Suddenly, Milken, who had always operated from the shadows, became the central figure in one of the largest white-collar investigations in American history. In 1989, the U.S. government unsealed a 98-count indictment against Milken. The charges ranged from securities fraud to reporting violations, most of them connected to how information and profits moved through Drexel's high-yield network. None of the charges accused Milken of inventing junk bonds. That part was entirely legal. But prosecutors argued that the speed and scale of his deals created opportunities for misconduct. Drexel, weighed down by legal bills, falling confidence, and a shrinking market, collapsed in February 1990, filing for Chapter 11 bankruptcy. For a firm that had once dominated Wall Street's most profitable era, the fall was stunning. Milken fought back, but the evidence, witnesses, and political attention were overwhelming. In April 1990, he agreed to a plea deal. 6 felony counts, including securities and tax violations. He was sentenced to 10 years in prison, later reduced to 2, and paid over $600 million in fines, forfeitures, and settlements. When Milken entered federal prison in 1991, it was the collapse of the kingdom he built, the empire that reshaped corporate America, and the downfall of the man once considered the most powerful financier in the world. The king had fallen, but the weapon he created was still very much alive. After the weapon, when Michael went to prison, many expected the junk bond market to collapse with him. After all, he wasn't just the architect of high-yield finance. He was its engine. But something remarkable happened. The weapon he created spread. Even as Drexel Burnham Lambert imploded, other Wall Street firms, the same institutions that once mocked junk bonds, rushed in to occupy the space Milken built. Salomon Brothers, Merrill Lynch, and Goldman Sachs all expanded their high-yield operations. Investors who once avoided anything below investment grade now treated high-yield bonds as a normal part of diversified portfolios. Pension funds added them. Insurance companies added them. Even conservative institutional investors reluctantly accepted that Milken had been right about one thing. The returns were real. And the companies themselves? Many that once relied on Drexel simply pivoted to new underwriters. Cable giants, telecom companies, energy firms, hotel chains. The entire generation of businesses that junk bonds helped raise from obscurity kept growing long after Milken stepped away. The market he pioneered became a permanent fixture of modern finance. By the late 1990s and early 2000s, the high-yield market was no longer seen as exotic or reckless. It financed everything from leveraged buyouts to corporate turnarounds to private equity expansions. Even during crises, like the 2008 financial meltdown, junk bonds remained a key source of liquidity for struggling firms. The weapon had matured, regulated, expanded, and professionalized. Ironically, Wall Street spent years condemning Milken, yet they continued using his financial blueprint to run entire industries. Analysts published research on high-yield spreads. Business schools taught case studies on debt-driven growth. Traders who once dismissed junk bonds were now managing billion-dollar funds built on them. Milken lost his empire, but the system he created survived his downfall, outliving the bank that built it and the era that defined it. The king was gone. The weapon had become part of the kingdom. Then came the redemption arc. When Michael walked out of prison in 1993, most people assumed he would vanish from public life. He had been fined hundreds of millions, banned from the securities industry, and cast as the face of 1980s excess. But instead of attempting a financial comeback, Milken did something few expected. He reinvented himself outside of Wall Street. His shift wasn't sudden. In prison, Milken was diagnosed with advanced prostate cancer, a diagnosis that could have been fatal. Surviving it changed his priorities. He began pouring his energy and personal fortune into medical research, education, and public policy. Over the next 3 decades, he became one of the most influential philanthropists in America, funding projects in cancer treatment, public health, student achievement, and scientific innovation. Much of this work was channeled through the Milken Institute, founded in 1991, which grew into a global think tank shaping conversations on economics, healthcare, and technology. Its annual global conference attracts world leaders, CEOs, Nobel Prize winners, and policymakers. A modern echo of the influence Milken once held in finance, but now directed at research and societal challenges instead of corporate takeovers. He also helped accelerate breakthroughs in cancer research, raising billions through organizations like the Prostate Cancer Foundation. His focus was personal, but the impact was national. Survival rates improved, treatments advanced, and entire research fields expanded because of the funding he helped mobilize. His reputation remained controversial. Critics argued that philanthropy didn't erase past wrongdoing, while supporters saw his transformation as proof that people can evolve. Regardless of opinion, his influence extended far beyond finance. Then, in 2020, something symbolic happened. President Donald Trump granted Milken a full presidential pardon. It didn't erase history, but it did close a circle. The man who once built the most feared financial weapon fell from power and reinvented himself in a completely different arena had completed one of the most unusual arcs in American public life. The king never returned to Wall Street, but he did build a second legacy, one that even his critics couldn't ignore. And that's it. Now to you, was Milken a visionary who democratized finance, or a king who forged something too powerful for anyone to control? And can both be true at the same time? Share your thoughts in the comments section below. Leave a like, subscribe, and turn on the notification bell for more amazing videos like this one.